From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for May 24th, 2024, Memorial Day weekend. Checking the calendar, your first-place Milwaukee Brewers are in Boston for the weekend. They'll be home Monday to welcome the Cubs, to be followed by the White Sox. Get ready for a Chicago invasion. And at the lakefront, the Gift of Wings. It's the IKEA Family Kite Festival, Saturday and Sunday. That's always a fun thing, so bring your camera. Today we're going international. Let's start with some crazy news from Russia. A pet monkey went on a wild revenge spree, injuring 5 people. Apparently the monkey became jealous when his owner brought home her new husband. So after being let out of his cage, the pet monkey drank some whiskey from an open bottle, and then he ran outside in a jealous rampage and bit 5 people. Hell hath no fury like a scorned drunken monkey. Only in Canada, Ontario Provincial Police were responding to a report that a vehicle had struck a moose and careened into a tree. The vehicle hit the tree, not the moose. The Canadian police called for an ambulance, and don't get ahead of me here, but you're right, the ambulance also struck a moose. Hey, they're 2 for 2. Those Canadians don't miss. Scientists at Cardiff University in Namibia, Africa, are putting their research to good use. They're brewing beer with yeast extracted from killer bees. They're hoping the new killer bee beer will create a buzz. I was expecting more groans than that. All right, let's segue from killer bees to killer whales. A crazy man in New Zealand was filmed jumping off a boat in what appeared to be a deliberate effort to body slam or touch a killer whale. The Department of Conservation saw the video, and the man was fined $600. An official described this 50-year-old man's behavior as absolutely idiotic and a real blatant example of stupidity. Well said. On the podcast today, we have Joel Driesing, Adam Baley, Tom Pappenfus, and wrapping up the week, here's Kyie Tetting.
Well, thanks, Max. A bit of a weird week for the markets. The NASDAQ up 1.4% this week, closing at 16,921. However, the Dow down 2.3%, closing at 39,069. Right down the middle with the S&P 500 up 1 point for the week, basically flat, closing at 5305. A quick look at numbers for the year. The NASDAQ up 13%, the S&P up 11.7%, and the Dow Jones Industrial Average, despite the negative week, still up 4.3%. You know, Adam, an interesting place, I think, to start the conversation, just the dichotomy between the Dow and the NASDAQ this week. You know, you could point to maybe 1 or 2 companies as kind of the defining part of that problem. But, you know, I think it also speaks to just the way the markets have traded in general. You know, what are you kind of seeing from this week's movement?
Well, the divergence between the Dow and the NASDAQ, basically the industrials versus the technology, the chip makers. And the industrials had a bit of a bumpy week this week. But then you take a look at the chip makers and technology companies, NVIDIA specifically. I don't know if anybody listened to their earnings call or the transcript, but my goodness, they made a lot of money, significantly more than analysts expected. And you had a huge rise in NVIDIA, and they took a lot of technology companies with them that kind of gotten swept up in the AI craze, but they're making a lot of money, and that was a big contributor to the technology sector this week.
At the end of the day, Thursday, NVIDIA's market cap, something like $2.6 trillion. The stat I heard this morning was that it made NVIDIA, just as a company, more valuable than the entirety of the German stock market. Now, not necessarily a fair comparison. Germany actually makes product, and NVIDIA outsources all the development of their own semiconductors. So, you know, maybe it's a different business line entirely than the country of Germany, but it was an interesting comparison when you kind of look at how much some of those businesses have run recently.
And, you know, when I saw that, I had a bit of a different take on it, where you have NVIDIA total market cap at $2.6 trillion. You add up all of the value of German stocks at $2.5 trillion. The way I read that one is, gosh, you know, European stocks look to be a relative bargain relative to U.S. technology businesses. So there's still some relative bargains out there, and maybe, just maybe, it's German stocks or European stocks at large.
Yeah, I think that's fair. And Tom, maybe that also speaks to a conversation you and I were having just before the show about some of the changing monetary policy, both here in the U.S. and some of what we're seeing in the rest of the world. Clearly part of what drives opportunity is the direction for currency, the direction for rates globally more broadly. And there seems to be a bit of a shift going on there as well.
Yeah, I think what we're seeing here is, our constant conversation is around when we plan to cut rates. And right now you're looking at other major economies in the world, Canada, Europe, China. They're basically at the point where they're facing recessions and see significant economic slowing. So they're already in the process of starting to cut rates and put that into place. When we get to that point where we're, stop talking about cutting rates and actually cutting, can generally, we've been dealing with a strengthening dollar for some time now. And when you look at, to Adam's point, look at other opportunities out there, in the markets, it's kind of the nice part. What we've seen this year with greater market breadth is it isn't 100% technology. It isn't 100% communication services. You've got energy, you've got utilities, you've got financials all doing very well so far year to date. Where do we find other opportunities? And I think some of the conversations I've had with clients of late is, when we start to see interest rates decline, we should start to see the dollar soften a bit. Right now up until this point, internationals have always kind of lagged behind, and part of it is due to a strengthening dollar as, those U.S. dollars, I should say those foreign revenues get repatriated to U.S. dollars and it buys less U.S. dollars. It certainly hurts our international holdings. That might start to turn into a tailwind in the not-too-distant future.
Yeah, I think it's a good reminder that, a strong dollar is, we always think of it as a U.S.-centric investor. A strong dollar is good, especially when you're traveling overseas. But as an investor overseas, it's a headwind against you. And a falling dollar, at some point, the dollar will kind of fall back to more normal levels. And at that point, it can be a significant tailwind to your non-U.S. investments.
We talk so much about kind of the state of the consumer, and critically so. It's 70% of our economy, give or take. And then, you look at, maybe some weakness in some of that reporting. Joel, we had consumer sentiment data today that, tells, I think, the same story we've been telling for a while. Not great, but also not as bad as maybe it could be. What are you seeing from that consumer sentiment stuff?
Not as bad as it could be and not as bad as it's been. So 2 years ago, it was at a record low for the University of Michigan surveys, which go back, I think, to the late 1960s. And today, the number that came out for the month of May for the index was up 40% from where it was 2 years ago. It's up 20% from where it was a year ago, but it's down to the lowest it's been this year. And the University of Michigan economists thought that it basically was going to be at a standstill this year up until the elections because of the uncertainty over, what happens with the presidential elections. But, it shows this underlying thing that we've talked about a lot, where there's this disconnect between how consumers are feeling toward the economy and how the economy is presenting itself, especially in statistics. I was reading a piece by Paul Krugman from the New York Times, who's a Nobel Prize-winning economist, and he said that he's actually kind of getting sick about writing about this. He said I've been banging on this drum for more than 2 years, just talking about that disconnect. And the latest numbers from the Federal Reserve and its occasional survey of consumers shows that people are thinking that the economy isn't that great, but they're also thinking that their own personal situations are fine. And there was another survey that came out recently by a Harris poll that showed that 56% of the U.S. consumers surveyed thought that the U.S. economy was in a recession. And it's not by, economists' definitions. And another number from that was that about half of all those surveyed thought that the unemployment rate was at a 50-year high. And it's at a 50-year low.
Yeah. I mean, talk about an enormous disconnect where employment is at a near all-time high. Wages are rising faster than inflation. We have robust market and economic gains, rise in real estate value, rise in investment asset values, and still historically low interest rates, and yet we feel glum, where we have this economic expansion, but a recession in confidence, and that is a significant disconnect that we're looking at.
Yeah, one economist actually calls it a vibe session.
I like that.
And I think in my conversations with clients, it's clear they're not slowing their spending. When I talk to the friends and family I have, I don't see any slower spending there. And when you look at the underlying data, well, it's clear that the spending really hasn't slowed down as much as we otherwise might think. Travel alone, we're hitting record travel days now. Atlanta, one of the busiest airports in the country, reported on Thursday the busiest travel day they've ever seen, more than 100,000 people going through the TSA turnstiles. They think today is going to be a busier day than yesterday was, today being Friday. And so I think if you're thinking through, well, yeah, the economy's not great for everybody else, but it's okay for me. If everybody feels that way, well, there must be something causing that disconnect. I think some of that clearly is just the world we live in now, the availability of negative information, the kind of decisions that are made sometimes to divide rather than to bring people together. But I also think it's just part of where we've come from, what we've come through in terms of a pandemic, in terms of some kind of geopolitical concerns that weigh fairly heavily. And so when you look at the data itself, it's a far different story than we're getting from those vibes.
And Kyle, another illustration of the power of consumers, we know that they drive 2/3 of the gross domestic product, the economy of our country. The consumers are still going out to restaurants. They're still eating. That's still reviving from COVID and from the lockdown. And basically, consumers helped eat Red Lobster into bankruptcy.
So wait, you're telling me that I overdid it at the endless shrimp buffet?
All you can eat for $20.
You're not supposed to pull up your chair to the buffet there, Adam.
That's only frowned upon.
It was on my list to talk about Red Lobster, less because of the endless shrimp and more just because I think it's a symptom of a bigger problem, a problem that has been created by, I think, the new version of the corporate raiders, the 1980s of buy out a company, lever it up with debt, and then send it off to die. And what we got with Red Lobster was, well, let's buy up a company, put our executives on their board, force our shrimp onto their menus, and, oh, by the way, take their land away, the land their restaurants are sitting on, and charge them exorbitant fees as rent. And so I think there is just this incredible shift in terms of the destruction of value for a business that mostly was doing okay. It had some struggles coming through the Great Recession, but that was otherwise mostly doing okay other than this massive overhang. And so, yeah, maybe Red Lobster's not the place I'd think of for, a nice family meal, at least not the first place I'd think of, but it was a restaurant that certainly gathered or garnered a lot of attention and, maybe not fair the fate it led.
And Kyle, some of the consequences of that, I think I saw a number of 8,400 people who would be out of jobs with all the closings of the Red Lobster restaurants. You don't think about that as much when you're thinking about these restaurants closing, but it add them up and it employs a lot of people.
It absolutely does, and those individuals certainly have opportunities to find work in other places, but that's never the situation you want, is being forced into kind of having to make a choice about, okay, what do I do next? Especially for those individuals that maybe enjoyed the benefits of Red Lobster and the endless shrimp that was available. So I think if we really think through, there's real consequences to the decisions that were made there. There's real consequences to kind of the ways that sometimes we try to squeeze profitability out of companies. And then, I think you look at the other side of that, which is there's a lot of great businesses out there that are well run that maybe aren't as susceptible to some of those problems. One of the challenges, Tom, I think we see is in some of those smaller businesses, smaller companies in general, which typically in this part of the cycle look pretty attractive. They can be businesses that are well run, that have good cash flow, that maybe look attractive as a takeover candidate at some point. And yet it seems like this time around in kind of our emergence from a bear market, we're not seeing the kind of rally we normally see there.
Yeah, generally coming out of a bear market rally, especially if it's on the cusp of an economic expansion, you tend to see the more economically sensitive smaller companies do well. But in fact, if you look at the way this performance we've seen in U.S. stocks this year, I believe the S&P since the October low going back to 2022 is up about 40%. The S&P 500. And you look at the Russell 2000, it's only up about 17%. It's kind of a flip or reversal of what we typically see, again, with small caps leading the way. So, I think that's not without cause. I mean, it's because the S&P has shown tremendous earnings per share growth, while the smaller companies have struggled, again, with some of the higher costs of inflation, labor costs, and things like that. But now, the way I look at these things, well, to our talk earlier about international potential opportunity.
And I think part of the disconnect here, too, is just what we're able to see. You go back 20, 30 years ago, a lot of those smaller businesses were publicly tradable businesses and publicly purchasable businesses. And a lot of those now are private, where you just don't see it in the same scope and as you did before, because a lot of those now are owned by private equity or just privately run businesses on the small and mid-cap scale. So it's just not within the visibility which we're used to seeing.
Add in the Apples and the Microsofts and the like have billions of dollars or hundreds of billions of dollars often in cash on their balance sheets. And it maybe isn't even that company is private equity. It may be that before they ever came to public market, Microsoft had already bought out all the best technology, or it happens a lot in pharmaceuticals as well. You've got this great invention, you've got this great potential drug. By the time you can monetize it, by the time you can get it to market, you've spent so much money that you can't even afford to get through the FDA approval process. And so as a result, a lot of those kind of younger idea generation companies end up selling those patents, selling that development to the big drug players because they're the ones that can afford to do the FDA approval process. And so I think some of this is just, there's really good opportunities in the bigger names, and some of it is the bigger names have already done so well that they've snatched up a lot of the smaller names. Joel, a couple other economic pieces from this week in particular. The housing market, we got existing home and new home sales both this week.
Right, yeah, the existing home sales is the bigger of that. It's it's multiple times larger than the new home sales. But one thing that we're seeing from the new home sales is that we're getting more houses in the housing stock, so that the inventory is slowly rising. And that's one thing that the National Association of Realtors keeps complaining about, is that there aren't enough houses out there to sell. So people who have houses aren't moving, and so that makes the cost of housing that much more, and that's another impediment to the whole sales market. So the existing home sales, they were down in April. They were down from the year before. But the positive of that, again, was that the realtors say that they're seeing inventories rise. In their figures, they actually showed that houses of $1 million or more in value, that the inventories rose 34% from a year ago, and that sales of those houses rose 40% from a year ago. So that's encouraging. And on the new home sales front, we had numbers from the Commerce Department that the new home sales are down from April, and they're also down from a year ago April. And they've actually been below the February 2020 rate just before we entered COVID. They've been below that level for 11 months in a row. But the supply is getting up there, and it's 9 months worth of houses that are available, and that's the highest that we've seen since November of 2022. So there's maybe some hope for that market in the coming months.
Yeah, and a little bump in durable goods orders in April. It's a sign that the economy continues to plot along. Maybe a little growth here, a little growth there, especially in the manufacturing sector.
Yeah, a bump is maybe a good way to do it, because it's really kind of been bumping along. Compared to a year ago, durable goods orders are up only 0.5%, and so that's pretty meek. But at least it's up, and it has been down. And April was the third month in a row where there were some increases in durable goods orders.
I think as I've probably repeated a dozen times over the last dozen weeks, it's more kind of mixed news, both on the economy, This week, mixed news on the markets, depending on whether you're looking at the S&P or the NASDAQ or the Dow. And I think it's just a sign that the economy we're in right now continues to be a little back and forth, a little uncertain, but overall positive. And so, I think entering a holiday weekend as we move into now the summer season, I think good signs that while there's plenty to be concerned about, there's also plenty of opportunity ahead. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.